Okay, last part of the notes is just really financial statements again. So what do all these adjustments do? Well, again, the impact that ends up happening is that with prepaid expenses, before we make the adjustment, all assets are usually overstated, so they have more than the value than what they're actually showing. So again, supplies would have been overstated by 1,500, and our expenses are understated. They're not showing the proper usage. So again, adjustment to it, we increase the expense, decrease asset, or we may end up increasing, of course, our accumulated depreciation, our contra assets. Unearned revenues, before the adjustment, our liabilities are overstated. They're showing currently we still owe our client all the money. While revenues are understated, they're not showing what we've actually earned. So to adjust properly, we decrease the liability and increase the revenues. Accrued revenues, again, are showing assets to be understated, and also revenues understated. The main reason right here, again, we've earned the money in the period, so our revenues need to increase. At the same time, we should have received cash, but we haven't. We expect to receive it, so we increase our accounts receivable account. So again, increase an asset, increase revenues. And then finally, our last bit, accrued expenses. Before the adjustment, both expenses and liabilities are understated. So we must increase expense and increase liability to show the expenses incurred during that accounting period, and shown that we do have an obligation to pay these expenses at a later date. So overall, this is all we have done in this chapter. Only 7 transactions, not too bad. Again, you can see they're all messing with the expense account. Oh, an income statement account, sorry. And now we get to actually create the financial statements again. Yay, more practice on these. So first off, remember, number 1 is our income statement. So, Sierra Corporation income statement for the month ended October 31st. Okay, so here all that ends up happening is, first off, we would have had the balances from here. So again, from last chapter, we can actually come over and we're going to make a few changes. First off, we know service revenue. So revenue's always first, and we only have service revenue. We can actually do this balance because it is 10,600. So next is expense. And the first one we're going to hit is, of course, salaries and wages expense. And we can adjust this real quick. Boom. Boom. There we go. Make it a little bit better so it's easier to see. So salary and wages expense is 4,000. Now, this is taking the 1,200 here, and previously the 800 we've already paid for. So again, we're doing a little change. So in order to do it based on this, you've got to have last chapter's financial statements. So supplies expense is our new one. That's our 1,500 that happened during adjustment. Rent expense, is still the same from previous. Insurance expense is new. Again, that's our $50. Interest expense is also $50. And now we have our depreciation expense, which after we've had all of our total expenses, we're going to take them and add them together, and they should equal to what we have right here for the expense column. Okay. Then finally, we find our net income. So after the adjusting period, we take our 10,600 minus our expenses of 7,740, and we come out to 2,860. Awesome. So, second statement, retained earnings. Now, again, since retained earnings is starting at the beginning of the month, we still have 0. Our net income should have changed, which it did. Is now 2,860 compared to last chapter. So last chapter was unearned. This year, not unearned, unadjusted. This one's now adjusted financial statements. Dividends do not get adjusted, so they stay the same. So now our retained earnings is 2,360. So the only one that's going to be in trouble is going to be the expenses. Okay? Because you got to pull them from the list over here. And then we have prior expenses due to last chapter. Remember, this is a continuation. So you can go all the way back up here. How far? Not there yet. Right here. Notice, here's our service revenue. Here's our salary and wages expense. And here's our rent expense. I think there's a little math issue. Yeah, there's a problem here. Bet y'all saw it too. Somehow, because I pulled this from the book. The book did not add this. Should be 6,200. So there. Right. So 4,900. Because we had salaries of 4,000 already. Yeah. And rent expense of 900. That's our 4,900. Yeah. Just happened to not have it as 6,200. Something doesn't add up here. I'm sorry. I'm looking at it. So we have 4,900. We may have caught the book in a mistake here. Plus 1,500 plus 50. Plus 40. No, it's right. Just we didn't do it right here. Just doing the adding real quick. Okay. I'm sorry. Something just feels weird. So, we started with 4,000. We added another 1,200. We should have 6,200 in salaries and wages. Plus. Oh, dang. No, I did that wrong. Plus. Oh. So 4. I did math wrong. Shame on me. That's 5,200. I had an extra 1,000 somewhere. Sorry, guys. Did all that and just wasted a bit of time. That's 5,200. I don't know. Y'all probably laughing at me, but that's okay. So let's finish up our balance sheet. So again, treat it always as a classified unless directed otherwise. So current assets. So we should have cash at 15,200. Nothing changed. And we can see it from here. 200 for our accounts receivable. Supplies is 1,000. Prepaid is 550. So total current assets is 16,950. Then we have equipment. And we're going to have less accumulated depreciation for total assets to be 21,910. And again, somehow they scooted up. As this should be property, plant, and equipment, or fixed assets, whatever, however you want to go. So, don't know how that keeps happening. Okay. Either way, there we go. So we end up with 21,910, exactly the same. And then of course, we push in our liabilities and our equity, again pulling the numbers from our table. And again, our current liabilities is any liabilities that are going to be less than a year. We know this note is 3 months, so less than a year. Accounts payable, salary and wages, unearned interest. So there's our total. No long term. And then of course we got our equity, which is of course our common stock, then retained earnings, and then finishing off, it totals up. And that's it for this chapter. I'm sorry it took a little time. I just saw the error, it kind of threw me off, and then of course somehow I added an extra 1,000 somewhere. Oh well, life moves on. So again, that's it for chapter 4. Let me know if y'all have any questions, and I will see y'all in class.